Hello and welcome to a new video on accounting for compound financial instruments. In this short illustrative video, I have explained in detail what is a compound financial instrument, taking an example of a convertible bond. Next, what are its key characteristics? And lastly, followed with a practical numerical example showing the accounting treatment of such an instrument. In addition, I have also explained how to split between liability and equity component, how the liability component is amortized, and how it impacts an entity's balance sheet and profit and loss, along with deferred tax effects. I hope you find it valuable. Let's get started. Accounting for compound financial instruments under IndAS. What is a compound financial instrument? It is a financial instrument that contains both liability and equity elements simultaneously. The important feature of a compound financial instrument that the return on the instrument is not just the consideration for the time value of money and credit risk, but also reflects the value of the issuer's equity. So this compound financial instrument having two elements, one is liability, remaining part is equity. Now it has one initial carrying amount. We calculate the liability component, that is the present value of the ultimate obligation, and the balance is the equity element, that is potential value of the conversion. So you see two things. Liability meets the definition of a financial liability. Out of the initial carrying amount, we work out what is the present value of the ultimate obligation. That is deducted from the opening carrying amount. Remaining part is the equity, that it is satisfies the definition of an equity instrument. This is actually value of the conversion. So there is no question of any profit and loss. So compound financial having two elements. One is the liability, which meets the definition of a liability. Present value of the ultimate obligation, remaining part of the equity, that satisfies the definition of an equity instrument. Example of a compound financial instrument, that is convertible bonds, convertible by the issuer into a fixed number of ordinary shares of the entity. So two things are important. First is it is convertible by the holder. That means what? It is at the discretion of the holder. If he wants to convert this liability into equity shares, that means you will have to relinquish the debt, and it will be converted into a fixed number of ordinary shares of the entity, not variable number. So it will be converted into a fixed number of ordinary shares of the entity. That is fixed number of ordinary shares for a fixed amount of money. So I repeat, two important things to remember. It is at the discretion of the holder, and conversion, if takes place, it will be a fixed number of ordinary shares for a fixed amount of money. Next, a convertible bond comprises both the following components. I told you earlier it has one liability component, one is equity component. So liability to pay interest at regular intervals during the tenure of the instrument. So This is the present value of ultimate obligation that we need to work out. And second thing is what? The equity component, which is basically a conversion option granted to the holder with a right to convert into a fixed number of equity shares of the issuer within a specified period of time. Now, this equity component, the main thing is generally low coupon that is paid. Interest paid is much lower than the market rate of interest. That means the interest that should have been payable had there been no conversion feature. That's why this equity component arises. And this is the value of the equity component. So I repeat, when one entity issues convertible bonds, interest payable generally much lower than the interest that should have been paid for ordinary, bonds. So that is why this is the value of the equity component. Take one example. Entity A issues a CU 1005% convertible bond on 1st April 20X1. Life 3 years, market rate of interest 10% per annum, income tax rate 40%. Now you see, this is the rate of interest had there been no conversion feature. This is called effective interest, market rate of interest. But you see, interest is payable how much? 5%, much lower than the market rate of interest, because there is a bonus element is given. There is some conversion feature. The holder can convert the debt into equity shares. First year, what is the cash outflow? Entity has to pay 50 rupees cash outflow interest, that is 5% on 1050 rupees. Discount factor 10% is 0.909. So 50 into 0.909 is 45. Likewise, next year again 50 rupees paid. Discount factor 0.826. Present value is 42. Last year 1050, 50 is the interest, and 1000 either it will be converted or the amount will be paid if not converted. Discount factor is 0.751. So present value is 780. Total is 875. This is the liability component, present value of the ultimate obligation. 1000 is the carrying amount, liability component 875. The difference, as I told you, that is the equity component. You see, equity component is 125. Difference between the initial carrying amount and liability component that we have worked out, that is the present value of ultimate liability. Now, this 125, it has two elements. One is net of tax, another is deferred tax liability. 125, 40% is tax, 60% 125 is 75. So equity component net of tax is 75. Liability, copy just 875, it is already there. Balance is your deferred tax liability. 125 minus 75, that is 50. So out of 125, two things. One is net of tax, that is the equity component 75, and deferred tax liability is 50 rupees. Right hand side, you see cash we have received. Now the aggregate is this. So I repeat, 1000 rupees you have received for issuing this convertible bond. We have worked out liability component 875. Balance 125 we have to allocate. What is net of tax? That is 75, 60% of 125, and remaining amount is the deferred tax liability, 40% of 125. that is 50. Amortization of liability component. Now, 875 is the amortized cost beginning, that is the on the date of issue, that is the present value of ultimate obligation. What is the obligation? Obligation is 1000 rupees after end of 3 years. How do you work out? So initial carrying amount is added with the interest element. Effective interest we have worked out 10% on 875, that is 88. Amount of interest paid is 50. So closing balance is 913. I repeat, opening balance 875. It is added with the interest element, that is interest calculated by applying effective interest on the opening balance 875. And what is deducted from this figure is cash outflow, what interest that has been paid. Balance is 913. So 875 plus 88 minus 50 coming to 913, that is the closing balance. That becomes the opening balance. Same process we follow. We apply 10% on 913 coming 92. Interest paid 50. Closing balance become 955. 913 plus 92 minus 50 comes to 955. That is the closing balance. That becomes the opening balance for the third year and the last year. 955, 10% interest, same as previous 95, and 50 rupees is the cash outflow. The balance is 1000. So present value of ultimate obligation is 875. That has become 1000. Our ultimate obligation. This 1000 rupees will be either paid in cash, if not converted. If it is converted, it will be converted into equity share capital. See this, 875 becoming 1000 rupees. Next, statement of profit and loss. When you follow amortized cost method, first of all, in profit and loss account, interest charge is the defective interest. That means we calculate fair value, what the interest that should have been paid, and there will be no conversion feature. You see, this is 88, 92, 95. See, 88, 92, 95. Now, deferred tax liability has to be reversed because we have paid interest 50, but we are charging at 88. So, deferred tax liability, we have opening balance of 50. 15 will be reversed. How do we get? 88 is the interest charge, interest paid 50, 40% is 15. Same way next year, interest charge 92, interest paid 50, 40% is 17. Last year, same thing. 95 is the interest charge, 50 is the interest paid, 40 is 18. So you see how total initial deferred tax liability, if you recall, it is 40% of 125. How that is reversed? Reversed in the first year 15, in the second year 17, third year 18. Total is 50. Next, balance sheet. Equity component is how much? It was initially 75. Now, 88 minus 50. 40% is my deferred tax liability. So net of tax will be how much? 23. 75 minus 23 is 52. I repeat, 88 interest charged, out 50 interest paid, 40% deferred tax liability, 60% is equity component to be transferred to retained earnings. That is coming 23. 75 minus 23 is 52. In the same way, we calculate this, you see, 92 is the interest charge, interest paid 50, 60%. 40% is deferred tax liability, 60% is equity component. to be transferred to retained earnings. This is 25. So 52 minus 25 is 27. And last year you see this amount is automatically balancing figure. Now you see amortized cost is 913. It's coming here, you see, we have worked out. Second 955 coming here. And third 1000. That is our ultimate obligation. Deferred tax liability, you see 50 is the opening balance, 15 is reversed, you see first year. What is the balance? Balance is 35, 50 minus 15. Second year, 35 minus 17, closing balance 35, 17 reverse, balance is 18. And last year it is, entire amount is reversed. Thank you. For more such videos on IndAS, please visit www.indasedu.com.